it creates a Pavlovian response. It's like I hear that and I know it doesn't matter where I am, Carter. I know it's 1:00 Eastern time. I guess that makes it like 10 a.m. on the West Coast, and sometime in between, if you're in those states, sort of in the middle. Makes sense, right? That's how the whole thing works. But this is Market Call. Today is Wednesday, August the 9th. Today's Market Call, of course, brought to you by FactSet, financial data and analytics, powered by Tomorrow. Dan Nathan is being powered by a jet airliner. That's a Steve Miller song. He's going to Colorado, I believe. Now, if he were here, which he isn't, because as I just said, he's in Colorado, he would have said, why are you doxing me? Which is something now I've heard a couple times over the last week or so. I have no freaking idea what it means. So if you want to put it in the comment section, have at it, people. That's what Dan Nathan is. I think it means when they say dox, it means like you document it. I think it's short for like documentation, but apparently that's not the case. Now, with me today for the entire show is the great Carter Braxton Worth of Worth Charting. How are you, Carter?
Who also doesn't know anything about what doxing means. But anyway.
Well, I don't know. I mean, I don't understand.
It might be happening to us right now. Who knows?
We might be getting doxed by a higher power, to your point. No, I'm with you on that. But listen, we're not going to sort of bury any leads here. The market, I think, is becoming a story. But before we go to that, a lot of interesting things going on in China. And let's just start with our first headline. I mean, you talk about something you haven't seen for a while. China slips into deflation in a warning sign for the economy. Now, this is something, you stay away from the fundamentals, as you say, but, this is something you've been talking about in relation to some of your calls. And we're going to talk about yields in a little while. And it's funny, when Ackman came out with his proclamation, by the way, he still might be right in terms of yields. You said it that day, that's probably going to be the top tick for a while. And as it turns out, that was literally the top tick. So we'll see how that plays out. But when you see something like this, how does it factor into your work, if at all?
Well, it doesn't. I mean, the principle being that you can't buy, right? There's no thing to buy China deflation. There's no ETF. There's no stock. You can have a view on that subject. You can have a view on COVID or global slowing. But at some point, you can do one or two or three things. You do nothing after doing all the work and studying the subject. Two, you could, chit-chat about it, talk to a neighbor, a spouse, still doing nothing. Or you go down to the market, down to the track, and make a bet. And that means finding some way to express a view on what you've learned or what you believe about China deflation and what that means for steel or coal or whatever. And so that's what charts are all about. It should start to show up in the action. And I think what we do have, and ironically, you referenced it, look, the whole world is staring at the chart of the 10-year yield, the tips, and it's almost so obvious that it's going to break out. Sometimes that's exactly when it doesn't. And
it's fascinating, right?
Yeah. I've had a lot of clients say, where are you? You're basically in the lower yields camp. Yields have peaked. But we're right there. Why can't it break out? And so the response that I've been sort of publishing and all my one-on-one calls and meetings in person is that yields are still now right below where they were on the 21st of October. That's almost a year ago. And it's either we just never do break out and we ultimately grind sideways or go meaningfully lower, which I think captures 90% of the odds. Or actually we do, and it's one of the greatest head fakes. It's a slight breakout, really draws the people in, only to then crap out. But the third scenario is up higher and meaningfully higher rates. I just don't see it.
Yeah. I know Jacob or Stephen Rafis, who's manning things back at headquarters, can pull up a chart of the TLT, because what we just looked at were obviously yields in the absolute form, but the TLT, obviously, you can look at this in terms of the inverse form. And this is interesting to look at. Again, the bottoming out here, I think for the eye, this might be a little easier to understand. We traded down to in the TLT, to your point, Carter, the levels that we bottomed out in October, effectively. I think the low then was 91 and change. I don't think we got as low, but you see what I'm looking at here. So, you can make a argument at least that maybe a bit short-term double bottom here, and we can trend up. Now, if we were to trend up to the moving average, it would suggest that 10-year yields, which again were just 4.2%, could actually get down to about 380, which is a pretty significant move. So I just wanted to look at this through the lens, obviously, of rates themselves, but then obviously through the lens of the TLT. I want you to take a look at something, Carter, and we're calling a bit of an audible here, but look at SMCI. This is super micro computer. This is still a $14 billion company. I mention it because this has been the poster child for the whole AI thing. And listen, none of us have denied the importance of AI and where it's going to be in the years to come. What we've sort of struggled with is the meteoric rise in some of these stocks. So when you see a company of this magnitude, which obviously had an unabated run from the spring until recent levels, move down 22% on what's going to be big volume, you see that unfilled gap below. I think this speaks to, obviously, this stock specifically, super microcomputer, but maybe some of the froth, Carter, in this whole AI trade.
Sure. So it is the number one performing mid cap and large cap stock in any index, Russell 3000, over the past 12 months. It is what a parabolic move is. And while they almost invariably go further than the imagination will allow, hurting shorts all along the way, what we do know is they always end the same way, which is you're priced at a level where everything known and that it could possibly achieve gets priced in. And this is the fascinating thing about markets. Or said differently, as long as you check back to your 150-day moving average, and you can see it's done that to the penny repeatedly, you can ascend for years. But when you pull away to such an extent and are 100, sometimes 200% above trend, above your moving average, the inevitable day like today is out there. And the really nuanced thing is there are a lot of people, remember, volume is heavy today. There are a lot of people who've been waiting with their nose pressed up against the glass, looking in at the party. I missed it. I'm waiting. It is almost never right to buy a drop in gap as a matter of technique.
Nick King has comments, Jacob and or Steven, if you could pull this up. Guy has no idea what AI stands for. Actually, Nick, I do. It means assholes in the chat room. So obviously I do understand what AI stands for. So there you go with that. I just wanted to sort of answer some of the comments we're seeing. Let's look at your charts, Carter, because you brought a bevy of them. And yes, I actually do know what bevy means.
It's so good. Yeah. I mean, there's value added, right? And then a comment like that. What is that? Whereas I was one of 6 siblings. One of my brothers says, look, Carter, there are two kinds of people. They're enhancers and they're detractors. So we know what kind of individual that is. Moving on. S&P 500, no lines, no drawings, no annotation, no judgments. Let's put some in. The first set of lines. Those two lines, those vertical lines, that's nobody's opinion. Those are facts, right? That's the high for January 2022. That's the low. We shall see for now. This is the uptrend since the low. That's nobody's opinion. Those are mathematically parallel lines. Now, let's take them all away and let's play the movie. We have had one, here it comes, drawdown. That was early December to late December. We've had a second, here it comes. And that was remarkably similar. That was February, March. Let's put in a prospective third. Now, that's what if you go down one day, is that a dip? Is that a sell-off? No, a sell-off, a decline, a dip, a drop, a correction, a drawdown. Forget the words. Those three, now put the channel back in. If and as we were to drop 9.2% from the peak, we're down about 3.5 now, and that would be right in line with the two preceding drawdowns since the October low. That would put us essentially at 4,200, which, forget the fact that it's a round number, is exactly where the channel comes into play. And at that point, I think the market would be in a healthier position. The bear, I would just say this, if you're bullish and you really think those October lows are structural lows for years to come, you want this drawdown to reset things. And if you're bearish, you want this drawdown because you think it's not going to stop at 9.2 in principle. It's going to end up being down 15 or 28 or more than that. Which is to say sequencing is important, and a continuation here, whether you're bullish or bearish, is what one should want.
So we'll stop it there for a second because, again, you would submit, and I would look at this and say, hey, that move, that potential 9% move to the downside really doesn't mean anything because, well, it means something obviously in so much as it's a significant move, but the uptrend would still be intact. And you would come here if, in fact, we got to that in sometime late in August or early September, and you would say the uptrend is intact. We draw the chart once again, and you now have arrows pointing up like you do right there. So it's important to point out that it's okay to be bearish in the context of what we're seeing. I mean, it doesn't mean the world is coming to an end. And I don't think any of us have ever necessarily said that. I will tell you that I do think a sell-off would be the most important and healthy thing this market can see right now, given some of the froth. And by the way, given some of the things that are going on. So I just beat you to the punch because you just drew those exact arrows that I was talking about.
Yeah, and then we probably have one final iteration with all the things. If you flash those back and forth, let's toggle, take the percentage away. Like, that's not random. Like, because I didn't make them. I mean, yeah, I've created the chart, but look where the level is. It's where the bottom of the channel. And you could say to hell with your channel, Carter, it's going to never get down there. Or to hell with your channel, it's going to cut through and go much lower. But that's all unknown. What we do know is the channel exists. And remarkably, were we to continue to sell off and go down as much as 9.2%, it would be remarkably similar to the two preceding corrections, drawdowns, declines, since the October low.
I think that's exactly right. And again, it's just something to watch. I think, somebody's pointing out that the market has bounced here. I guess the Treasury auction went well. I'm not looking at it, so I apologize. But you are seeing the S&P probably just bounce about, I don't know, maybe 5, 6, 7 handles. So it's something we'll watch for the remainder of the show. But let's continue because obviously a NASDAQ chart now. These are the charts that our crack staff of Amanda, Jacob, Stephen, Rafis, and maybe even Sam got involved, drew. Now, those are our lines. I'm not suggesting they're the correct lines, but again, this is an uptrend in the NASDAQ 100. Basically, from the beginning of this year, that trend is intact, as opposed to what we just saw in terms of the S&P. We are actually at an uptrend line here. So this is going to be interesting to see because if the S&P falters, it stands to reason that we might see some follow through to the downside in the NASDAQ, Carter.
Right. And so, again, it's where we are in relation to where we've been, or said differently, in relation to preceding intermediate highs and lows, as well as a series of highs and lows which make a trend. Now, in terms of the NDX, and that's going back, there's important whether to use a line chart, right, or a high-low bar chart. But there's every indication, at least my work, that we're going to undercut, break below this line. We know that certain key stocks have, Apple being the poster child for that. But my hunch is that this is not enough of a correction to correct the steep, uncorrected nature of the move since the year began.
You made a call in the energy market, I believe, and we have a graphic that substantiates it, July 10th being the date. Today is, as I mentioned, August 9th. So I would submit that's about a month or so. And you basically said, I'm going to cut to the chase here, buy energy. And I got to tell you something. That proved to be not only timely, but extraordinarily correct in a very short period of time. So let's walk us through some of the charts that you brought with us. Because I will say this, by the way, I agreed with you then. I agree with you now. I mean, there might be an inclination to take your foot off the accelerator. I think it's just getting started. But walk us through it, Carter.
Yeah, so it's been that was July 10, and here we are, August 9. So 1 month later, happily, a little bit of good time, a little bit of good luck. You need all of those things. Energy is the best performing sector. It's up 8+%, and the S&P is up 1.5%. But the lines, they lend themselves to the process. So this is the XLE. Look at those lines. Now, let's put in some arrows. An uptrend line is meant to serve as a reference point, and if something that's in an uptrend or a downtrend continues to respond to the trend line, the thesis is, the thinking is, technique is to continue to play it accordingly. But what we have now, and that was the point of the July 10 month ago report, is that we're now, of course, starting to show enough strength to get us above the minor downtrend line in a sense since the peak. And I suspect there's at least more relative to go, because remember, all energy has to do is go sideways here. And if you get a drop in NVIDIA like that super micro job, you know what's going to happen. XLE is going to continue to show relative performance to the S&P.
We brought some of our charts along, so let's take a look at it. And we're trying to keep pace with you. Obviously, this is, I believe, the OIH. I know it is, actually. And this is something that I've talked about for a while. We are now making multi-year highs in the OIH. We're through the levels we saw late last year, early this year. I think significantly enough where this is going to start to follow through. I don't know if Stephen can pull up sort of a 5 or 6 year chart of the OIH here on the fly, just for context. But I think we're looking at the same thing. You mentioned XLE. We're looking at OIH now. Again, as you can see, we're getting to levels we haven't seen in quite some time. So what are your thoughts here, Carter?
Yeah, what's holding, just to consider this, if you were to look at the XLE, which have been to track the actual S&P 500 energy sector, but you could also look at the equal weight sector, because the sector is so dominated by Exxon, Chevron, and one or two others. The equal weight is making important new relative highs to the actual. And so it's because of stocks such as Schlumberger, Halliburton, but also Tidewater, Diamond Offshore, etc.
Let's continue with crude oil, because there were a lot of calls for a breakdown in crude. It got, a couple times. And this is one where, in retrospect, you could say it held, but I got to tell you something. The second, third, fourth time down, it certainly appeared as they were going to pierce it through that 65 level, and it never happened. And here's some $18 or so later, we're at levels where we saw last in early spring.
Right. So, ironically, right, the street got quite bearish, calling for 45, 50 recession at those lows, just as after the Ukraine war, we went to 140. Three publishing houses, the biggest of all, even 250 a barrel, 300. When you get that kind of hysteria, yeah, it's almost always right to go against Wall Street, to go against the sell side. Here and now, of course, it's a big move to a difficult level. I think one would try to have one's cake and eat it too. Stay long and sell calls.
I don't know what, you got to address what do they call it? The gorilla in the room. But I keep hearing this sound like I'm not sure what it is.
Oh, that's on my end. Someone's doing masonry work.
All right. So that solves that riddle.
That wasn't your phone on extra vibrate. You thought
no, I'm like saying myself, is that me? I mean, I know I had Chipotle last night, but I didn't think it was that bad or noticeable. And good thing, as they say, this is not Wonka vision, but I digress to a point. Now, you'd make amazing calls all the time. By the way, you also point out when you're not right, but when you got spot on was Akamai. So let's go back in time, shall we? And let's look at your comments about Akamai.
What was this? Oh, right. So this is This is yesterday morning. Akamai going into earnings. We're doing one on Baba now for clients that has earnings after the close tomorrow. But let's go through the charts. So one way to draw the lines. Next one, another way to draw the line. That's what's happened today, happily. Okay, so Akamai, yes, we have a nice result. It's up 10%. But that setup, it's awfully nice, right? A lot of tension in that a move. A very poor performer. Look, to think, everyone knows the market makes a low in October. So does Akamai, but it makes shocking new lows in March, a real dog. But again, a setup like that going into an event has pop potential. So with a little luck, we popped today. And ultimately, we came close to filling this gap up here at 110.
That's right. So that was going to be the next thing I said. And I don't know if you have a chart that illustrates that gap, but if you could go back to the prior run real quick, we'll take a look, because there is that gap in the chart that was created by a downdraft that actually set up a move from last summer into this spring. So it lasted quite a long time. But this move today finally resolves, I think, if it didn't happen in its entirety, resolve that gap that we had on the upside that was created on a move to the downside. So this is me just looking at it. This resolution today on what's probably going to be a great deal of volume, is your opportunity, I would think, Carter, to be taking money off the table, not adding to a long position. Again, that's just me. You might have a different view.
That's aggressive to add here. I mean, I think there is the way to sort of, again, have cake and eat as well, which is to sell calls and stay. But certainly when you have an outsized payday, to think, look, we know that equity markets return about 8 to 9% a year on average. If you get that in one day, yeah, maybe just take a little, as they say, bulls, bears, and pigs, right? Just maybe take a little off.
The Walt Disney Company, I believe that's what it's called now. You talk about a stock that, forget about this year, a stock that is really not performed now. I mean, it had a big move at one point. I think it was north of 170, but here we are in the mid 80s. Reports earnings. We're probably going to lead fast money with it tonight. Let's take a look at it because there's some implied moves, and you put out a poll. Chart 1, further move to the downside. Chart 2, a little bit of a double, maybe triple bottom, resolves itself with a breakout of that downtrend line. And it's interesting. I mean, you took the poll. In terms of institutions, they seem to think one thing. Your subscribers seem to think something else. So looks like the subscribers want to be bullish of Disney. Yeah,
and my own vote, which subscribers are aware of, is that we break here. So we shall see. But what's interesting is, several thousand response on Twitter. Twitter is sort of splitting the difference. But institutions have a very sort of negative bias here, as revealed. Those are identical charts. And I guess I would just say this, that my conviction's not high. If it were high, I would have put out a buy Disney report or sell Disney report, no different than Akamai or any other report, energy, or the BABA one that's coming out. But I think it's really a coin toss here. Hence, I thought it'd be fun to do a poll, and you can see how people responded. Those are identical charts. I've just annotated them differently, and it is literally going to be the green arrow or the red arrow. This is elemental. I don't have a strong view.
Yeah, nor do I. But I do have a view about this because, as I think, you can make an argument either way at these levels. But first of all, we're down below levels we saw in the worst part, I think, of COVID in March, April 2020. I don't know if we can do a Disney chart longer term, Stephen, but I'm pretty sure we broached or breached those levels.
Well,
so that's number one.
Yeah, well, you can see it on this chart on the left.
Right.
Not quite at the COVID low, but I mean, essentially, we're at the COVID low, which is
amazing if you think about it. I mean, it really is pretty amazing. So at least you have that working to your advantage in so much as here we are, potential for a bottom based on that, number one. Problem on the other side is, I think, this could be the quarter with you've seen some of the management changes at Disney where Bob Iger just throws all the shit basically at the wall that he possibly can, completely kitchen sinks things for a reset. Now, market could take that one of two ways. They could be like, great news, this is our opportunity. Or they could say, you know what, clearly you haven't figured things out. There's more room to the downside. And I think that speaks to exactly what your poll is. But I will tell you that if you ask me to handicap this thing, I think you're going to hear a lot of bad rhetoric out of this conference call tonight. Now, whether the market interprets that as good or bad, I don't know. But buckle up because I think this conference call for Disney is going to be really interesting, Carter. Thoughts on that?
Yeah, and right. And what Guy just said is important is that it could be, if they kitchen sink it in the reaction, it could be, wow, these guys have taken their medicine and people like it. Or, wow, you guys clearly have a lot of problems still. But you could also get both of those in the same day, which everyone knows it's the kind of thing on the open. It's a crisis. It's down 6, 7, 9%. And then all of a sudden, starts climbing back and shakes it off, close on the high, and you have what is known as a capitulation day, and it marks the low. You can get all of that in one day. But again, I think it's pretty close to a coin toss here.
I agree. Eli Lilly is a name that I know you've talked about, I think, on Fast Money, on Market Call. We've been preaching about for years, and that's not hyperbole. It just happens to be fact. Now, the problem, of course, is analysts are starting to get involved. So we just throw this headline up. Jefferies upgrades Eli Lilly as enthusiasm around the weight loss drug Wegovy continues to sort of manifests itself. Here's the problem. I don't know if, again, I know Stephen can do this because he's done it a number of times. Pull up a chart of, real-time chart of Lilly over the last year or so. And this move, and now what is a $500 billion company, is a little overboard, I think. And I love Eli Lilly, but man, oh man, when you see something like that, when you see this island formation yesterday on what was a huge volume day, and this is after a big move to the upside, my antenna go up in a major way. Again, you talk about analysts being late and sort of all the headlines sort of signaling. You talked about it in crude oil a couple of years ago when all the analysts were preaching $150, $200 oil. That proved to be the top. And it happens over and over again. And this is anecdotal, I know. And I'm not picking on the Jefferies analyst at all. But, I mean, really? You're not helping anybody here. Thoughts on that?
Right. I mean, maybe we can get a 10-year chart just to really put some perspective on this. The thing that comes to mind, look, Pfizer was the great leader for years, and Lilly and Merck were lesser. Pfizer's on its knees now. Things change. But there is something people refer to perpetual motion machines. That's one that runs indefinitely without an external source of energy to power it. And guess what? It's not possible. It violates the laws of thermodynamics. The question is, I mean, who the hell doesn't know about Lilly? What isn't priced in? And one could say, well, it could actually come out with this drug and it could all keep going. It's a lot already. And so, trim. If anyone is in such a fortunate position to have this, has it right now, has profited, you reduce. You can still stay with some, still stay with a lot. Take 5% off, take 30. But just sitting around waiting, thinking it's going to double and triple from here, that's not my thing.
I agree. And, this again, when you see a huge volume day, when that island is created, I love Eli Lilly, the company, and we've said this for a while. This is not an indictment of the company at all. It's just sort of things get a little ahead of themselves, and I fear that might be going on here. I'm going to call another bit of an audible here, as it is preseason football season. Let's take a look at Valero real quick, VLO. If you could do like a 5-year chart, Stephen. I bring this up because very quietly, and we have CPI tomorrow, which everybody's going to be looking at, but you look at this chart, Valero had that huge move, which made sense early last year. You had the sell-off, you had the subsequent move higher, and a sell-off. Well, the refiners are back on their horses, and crude oil is something we talked about earlier, Carter, but something that's been going on that nobody seems to want to talk about is the move in both gasoline and heating oil. And sort of, we call those obviously the products in my world. And they've all been moving to the upside in a meaningful way. Now, say what you want, and I've said this for a while. I just sort of throw it out there. I have no idea what CPI is going to be tomorrow. But I do think beginning tomorrow, over the next couple months, you're going to start to see this reacceleration of inflation, which I don't think augurs particularly well for the market. But this is one of the things, Carter, you want to watch, and for the audience listening and watching also wants to take a look at. Keep an eye on names like this that obviously are levered not necessarily to the price of crude, but to the underlying products, which obviously have a huge impact on what inflation does.
Yeah, I mean, it's the real, look, crude's been great. The real dynamic thing is nat gas, right? That is one of the highest beta. It's literally the commodity that's referred to as the widowmaker. But nat gas has all the elements of a bearish to bullish reversal. We shall see, but my bias there is on the long side.
It's interesting. Somebody, Jay Luther, is saying, I love Lilly. It's funny. If you watch TV, which I'm sure most people here do, I would say, and this is not, I don't think this is hyperbole either. I think every third commercial is a pharmaceutical. It's quite remarkable, actually. And my question to my wife, who works in the industry, is who are they advertising to? It's like, if you're an individual, you're not walking to the supermarket and say, hey, I want that Wachovia. It's just, they're planting the seed. And this Jardiance commercial, where you have just a slew of people in the middle of a square singing what is a very catchy tune. I mean, they spend a shitload of money on these commercials, and it's amazing. Anyway.
It is. The ones that I always think, there used to be sort of the industrials like a Raytheon, or Boeing. Who the hell's buying a jet or nuclear sub? But hey, they do it. It's it's all part of
It's all part of it. And who am I to cast aspersions? But I'll tell you who I am to cast is the end of the show. And I want to thank the Mason out there at Carter's building. I'm sure he or she is doing yeoman's work.
Yeah.
Carter Braxton Worth will be on CNBC's Fast Money tonight. So you're going to see the transformation right before your eyes. He'll be sitting next to me on set tonight. Obviously, thank Carter. He does extraordinary work. Check out Worth Charting. Obviously, thank you, FactSet Financial Data and Analytics, powered by Tomorrow. Dan Nathan is obviously powered by the Rocky Mountains and all things that are Colorado. We will talk again tomorrow when I'll be here with Elizabeth Young, EY of SoFi. And get ready, people. I mean, we might lose three-quarters of our audience. Typically, Thursdays is a Butters Day, as you know. But friggin' Butters is on vacation. So I'll just say Butters a couple times tomorrow. I will invoke him regardless. Thank you for your time, folks. We'll see you tomorrow.